Well, folks, in my opinion, the Fed is either panicking or lying to us about the coming recession, and the stock market realizes it. That's why stocks are falling as the Fed meeting once again ends, and once again bond yields are rising, with the 10-year now rising up to 3.45%. Now, maybe that's just because, last year the Fed spent the entire year telling us that inflation was transitory, while the Delta variant was destroying our supply chains, and we printed even more money. But don't worry, now any kind of recession is sure to be transitory, because after all, the consumer and markets are very strong. Consider what the Fed told us yesterday. The Fed told us yesterday that the consumer is strong and the economy is doing very well. Yet look at this chart. It's a chart of consumer sentiment in the United States being at 22-year lows. It is literally at the lowest point since the dot-com bubble didn't even bother people, and it is not even as low as the 2008 recession. That's right. We are the lowest point in the last 22 years on the chart. People are worried, and they're worried because they realize that not only do we have the hottest inflation that we've had in 4 decades, but they realize the Fed might not know what the hell they're doing. And so, as you can see, with inflation, we had a peak in March, followed by a decline in April, which was good. But unfortunately, another higher peak in May in terms of inflation. And so while Jerome Powell talks about strength, we're kind of scratching our heads going, wait a minute, why then is inflation going the wrong way? And why is consumer sentiment so low? And on top of that, you've got the U.S. savings rate as a percentage of personal disposable income at just 4.4%. Yet again, another metric that is at a low since 2008, where it was actually slightly lower, but also quite freaking low. And so it does make you wonder, why does the Fed, Jerome Powell, and their buddies, why do they all think that GDP is going to end at 1.7% at the end of the year? It doesn't quite make sense. Even the Atlanta Fed's GDP Now tracking indicator doesn't seem to agree with the Federal Reserve themselves. The GDP Now indicator went negative in Q1. And guess what we ended up having for GDP in Q1? A negative read. Guess what the GDP Now data hit again today? Negative. We are once again negative. You can see it here on the chart. Now, according to this chart on screen, if the GDP Now chart is correct, we will fall into a recession. Because after all, 2 quarters of negative GDP is a recession. And see, the Fed is telling us, oh, but don't worry, we have no plans of inducing a recession. In fact, they want to be very clear that we have no plan to induce a recession.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do.
Well, the stock market doesn't believe that the Fed can avoid this. And the stock market knows that if we compare all the way back to 1929 and all of the crashes that have happened since 1929, in times of a recession, at least with how mature we are in terms of this crash now, we have at least 2 more large lows to hit before we can actually say we've hit bottom. Now, if we don't have a recession, maybe we're already at bottom. But markets aren't convinced that we're going to be able to avoid a recession, especially as we get sledgehammered by the Federal Reserve with a 75 basis point hike. Now, consider this. The Federal Reserve told us in May that 75 basis points of an increase for the FOMC, federal funds rate, was off of the table. And yesterday, what did we get? 75 basis point. Now, we believe this was leaked to the media on Monday via like a text or a phone call because the Fed was in their blackout period and they wanted to kind of prep the markets. And so then they prepped the markets. Markets priced in the 75, and sure enough, here's your 75. That was after the CPI data showed a meaningful and broad-based increase in inflation data, not a decrease. And this wasn't just certain categories. It was literally everything. And we saw a bump in consumer expectations for inflation before the CPI read even came out, which means our next read for consumer expectations for inflation will probably be even worse. Now, Powell, of course, says this was him adapting. Well, markets aren't convinced that he's done adapting. And even though yesterday Jerome Powell promised that, well, I shouldn't say promised, but set the expectation that, quote, we do not expect moves of this size to be common, and that this is an unusually large hike. the Fed may have lost some credibility. Because again, here we are, looking at consumers and looking at the economy in a much substantially weaker position than what the Fed seems to be telling us about. And so how can we believe that they're going to be credible to say that 75 basis points are unusually large, when it's entirely possible in the July meeting we could end up with a 75 or even 100 basis point hike, and the Fed will just have to say, well, we had to adapt. Folks, there's no cheering with the Fed until inflation actually starts coming down. But it gets worse because the Federal Reserve changed its tune a little bit on something else as well. But first, folks, I want to give you some free options flow data. That's because now we've partnered with Tendies to give you a superior Reddit browser that puts everything in one place. Charts and stock tickers, you name it, all in one place. And all you have to do is go to metkevin.com/tendies to check it out. Seriously, my favorite part is the free options algo flow. This is the kind of stuff that usually costs like $40 plus a month, but Tendies is giving it away for free. So now you can identify unusual option contracts that are prime for further moves to the upside or downside in certain stocks. And if you connect your brokerage account, Tendies will even personalize the app to your positions. You'll get personalized charts, tickers, Reddit feeds, all tailored to your portfolio using live data. Everything. So you don't need to switch apps. Everything you need for due diligence, all in one place. And right now, it's only available for the Apple App Store, iOS. Go to metkevin.com/tendies. But Android is coming soon. Just make sure you go to the description in the link down below, download the Tendies app, and connect your brokerage to take advantage of the free options flow data available now. Again, go to metkevin.com/tendies to check them out. So, what's another reason that the Fed is freaking markets out right now? Well, yesterday we kind of brushed this off. It had to do with the Federal Reserve kind of dropping their mention that they want to keep a strong labor market. The market's finally realizing, however, now, and I kind of mentioned that this was odd in my summary video yesterday, the market is finally realizing that Jay Powell is giving up on the dual mandate. Remember, maximum employment and stable prices. Well, we've got maximum employment. In fact, we've got more than maximum employment. So Jay Powell's kind of like, that's not really our goal right now. Our goal right now is just inflation. Getting inflation down. So we don't really have a central bank that has a dual mandate right now. We have a single mandate Federal Reserve, and that is to crush inflation. And the easiest way to crush inflation is by destroying demand and, quite frankly, inducing a recession. Even though Jay Powell tells us, don't worry, that's not the goal, we know this is pretty much what it's going to take. And that's unfortunate, and that's what the market is pricing in now. Now, even if the Fed tells us they want to see, drops in CPI for them to relax on their rate hike cycle. Just a few months ago, the Federal Reserve was telling us, we're really just looking at the month-over-month data and core CPI. As long as core CPI and the month-over-month data comes down, okay, maybe we could pause on our rate hikes. Well, Jerome Powell once again flip-flopped on this, and now he's telling us that no, we actually want headline inflation numbers to come down. Sure, core and month-over-month data matters, but we really want that core to come down. The headline number to come down. This is really bad because if Powell wants the headline number to come down, the only way to achieve that is by, with monetary policy, since we can't really control commodities and control supply. The only way to achieve that is with straight-up demand destruction. Like, folks, if you are tired of high oil prices and gas prices, which I'm sure you are, and high energy prices, and the Fed is as well, and we want to see that headline inflation go down, which is heavily driven by energy prices and food prices, commodity prices, the only way to drive that down is with straight-up demand destruction. And the Fed has to get people to drive less, spend less money. Now, California seems to have a different opinion. California seems to think we should give everybody $400 so they can go buy more gas and continue having demand. So why drive less when you could just get free money from the state of California? Oh, freaking California. Folks, it's so idiotic. It's so moronic. I'm sorry. I just had to take a little tangent there to say that. But you know what? The good news is we're kind of like Tesla in that if you check out on the programs on Building Your Wealth down below, you know you're going to get the best price, because Tesla just raised its prices by about $6,000 across the board for, well, I mean, not for every single model. I think the Model 3 was up about $2,500, and the max price increase was $6,000 for vehicles. But here you go, Elon Musk again raising prices. It's almost kind of like the best investment so far this year is a car, like a Tesla car, and not actual Tesla stock, which is quite ironic because usually it's the opposite. Usually cars go down in value. But anyway, if you want to lock in the price of a Tesla, you pre-order it now. If you want to lock in the price of amazing programs on building your long-term wealth with continued lectures and perspectives and a ton of research coming to you via beautifully put together lectures that teach you how to fish rather than just give you fish, well, check out the programs linked down below on Building Your Wealth, and make sure to use the coupon code before the end of next week, which is next Friday. Check it out. All right, folks, let's keep going over here with the Fed. See, the problem with the Fed right now is that the stock market is not just pissed that the Fed is, dropping labor from their arguments and focused on inflation so heavily, but it's that the Fed doesn't even realize that by creating well, I'm sure they realize, but they're certainly not talking about it. But by creating the kind of demand destruction that they need to get inflation down, we will maybe not have a recession. Fine, maybe they're right about that. But we'll have an earnings recession, which is just as bad. If anything, it's actually worse for stocks. Quite frankly, I'd rather have a not earnings recession and a regular recession than have an earnings recession and, I'm confusing myself here. The point is, I don't want an earnings recession in stocks because then stocks plummet. You have a regular recession, but you still have earnings going up. EPS is going up. Well, maybe that's not that bad because EPS is strongly correlated with long-term gains for stocks. The problem is stocks are just getting reamed, and so is the bond market. I mean, look at, for example, Peloton, a stock that's already down 90%. Now their bonds are selling for 70 cents on the dollar. Revlon just filed for bankruptcy. And to add insult to injury, people are still raising prices, contributing to inflation. Yes, that includes Tesla. But folks, it's not just the United States. Germany just saw the biggest increase in 5-year yields since 2011. The Swiss National Bank just dropped a bombshell surprise of a 50 basis point hike. Nobody was expecting that. The ECB just had an emergency meeting where they're planning on announcing a new tool to announce something to basically help deal with surging bond yields because they realize the bond market's collapsing. They also had the following to say, which was not good. They said, quote, inflation may end up being more entrenched than we think, and sentiment is worsening. Great. Last thing we want is central banks telling us, maybe inflation's more entrenched than we thought it was. Top of that, the Bank of England is expected to hike rates today. The Reserve Bank of Australia is signaling a period of substantial rate increases ahead. But, folks, don't worry. We won't be hearing a lot from the Fed for a while, right? we should be good. I mean, we just had the Fed meeting, right? Wrong. The Fed Speak calendar is back. So I've got it written down. Let's see here. Fed Speak calendar. Powell talks at a conference tomorrow. On Saturday, Waller speaks. On Tuesday, Mester and Barkin speak. On Wednesday, Powell speaks in the Senate, and Evans, Barkin, and Harder speak. Then on Thursday, Powell speaks before the House. Oh my gosh. I kind of like the blackout period better because this is a disaster. But then again, maybe Ben Bernanke was right. The Federal Reserve thinks that monetary policy is 98% talk and 2% action. And folks, this is all a complete disaster. And the Fed is, in my opinion, either just panicking, entirely wrong about the strength of the markets or the economy, or they're just straight up lying to us. Because that summary of economic projections, sure, it was a revision, but it wasn't a real revision.